Okay, I'm very excited to be talking to Colleen Jaconetti. She is not only a tax expert, she is also a certified financial planner, just like I am. She is a senior investment strategist in Vanguard Investment Strategy Group, which is a team of global economists and investment and portfolio construction strategists who try to help clients. Colleen, before we dive in with all the questions, I just want to understand, I talk a lot about the difference between strategy and tactics. I actually talk about it on the chessboard, and I always try to use that as a metaphor for investing. When you talk about strategy for clients, what are you referring to?
We're just really referring to like a high-level plan. So most planning happens ahead of time, and then when we talk about tactics, it's kind of like implementation. So let's put together a high-level plan, and then we'll get into the details with implementation as far as the tactics go.
A big part of what you do is you deal with retirement planning, which is for people before retirement, and then there's the post-retirement, actually, what do you do that now that you're retired? I don't think we're going to be able to cover all of that today because that's kind of managing your money for your whole life. But let's take a minute to talk about something that I know that you deal with a lot, which is called dynamic retirement spending. Let's start with the definition, and then we'll go into some of the details.
Right, so the dynamic retirement spending strategy is really a hybrid of two traditional strategies. So there's the percent of portfolio strategy where investors would spend the percent of the portfolio every year, which comes along with a bit of fluctuation in income as a result of the market movements. And then there's a dollar plus inflation strategy where people just spend a certain dollar amount every year and they grow it by inflation. That's really like the 4% rule. Follows that strategy. So what we're saying is we think the dynamic spending strategy will offer the best of both worlds. So we have a strategy that is responsive to market changes, but it also has limits on it so it doesn't cause significant fluctuations in annual spending from the portfolio.
Okay, let's break these down because actually all of the strategies you mentioned are different ones that people use. The first one you spoke about was where you spend a percentage of your portfolio. So, for example, you're saying if someone retires and has $1 million, he might say, okay, I will spend 4% of my portfolio, $40,000 a year, the first year. But then the next year, it could be more or less, depending on what happens to the portfolio. Is that the first model?
Yes, exactly. So that one is highly influenced by what happens with the markets, right? Because the end-of-year balance is really dictated by what happened in the markets that year. So some markets can be more volatile.
Yeah, I always tell people that you don't want your retirement spending to be determined by what's going on in the market because you might have a dream in your retirement to go on vacation or to buy a house or to help your kids, and all of a sudden the market goes down and you don't want your dream to be shattered because of that. So that then leads to the next model you said, which you described as like the 4% rule linked to inflation. Spell that out a little more.
So basically, at the beginning of retirement, a retiree would select a dollar amount, say $40,000 on $1 million portfolio, and then they would grow that amount every year by the inflation rate. So basically, they would be having real $40,000 spending throughout retirement. And the big problem with that is it does not adjust to the market at all. So it's great for retirees to be able to budget, but if the market should go down maybe 10, 15, 20% a number of years in a row, and someone is continuing to take out that 4%, which now is probably something a lot higher than 4% given their portfolio went down, they could actually be having a higher probability of running out of money before the end of their retirement.
I know that a lot of people who may have a lot of money can do what I'm about to say, and maybe it's not for everyone, but sometimes people, to answer your question, they'll say you should break up your portfolio into different buckets, and one of them should simply be a short-term investment portfolio, literally in cash or money markets or short-term CDs, that could cover you for not just 3 to 6 months, but possibly 2-3 years. And then the rest of the portfolio could be invested a little bit more dynamically or invested for growth or for income. Would that solve the problem of a bear market for a couple of years?
Yes. Depending on the length of the bear market, that is actually, certainly a prudent strategy and something that some retirees, quite frankly, are just more comfortable with. The relative give up in return from having that portion of the portfolio in the stock or bond market and helps them sleep at night is worth the trade-off to them.
All right, so thank you for taking time to go through these definitions because it's important people realize there really are a number of different strategies. Now let's dive into the dynamic retirement spending strategy. What's this all about?
Similar to the percent of portfolio strategy, you would take a percent of the annual year-end balance. So the prior year-end balance, say we'll take 5% of that balance, and then we will calculate that number. So we'll just say it's $50,000 for this example, and then we would compare that number to a ceiling and a floor. So before the strategy would start, you would decide, okay, if the markets are up, how much would I want my spending to increase each year? And maybe we say we use a ceiling of 5%. So the year-over-year change in spending wouldn't go up by more than 5%. We also select a floor. We're saying if the market goes down by 15%, how much can you actually handle in reducing your spending? So there we may say maybe only 2.5% decrease in spending. We calculate the annual spending, a ceiling and a floor, and then we look at that annual spending amount and say, is the amount we calculated higher than the ceiling? If it is, that means your portfolio, the market return was higher than the amount that you had adjusted for your ceiling, then you only spend the amount up to the ceiling, right? So you do give yourself a raise, but you reinvest the difference in the portfolio. If the amount you calculated that year is below the floor, you limit the spending to the floor. So you don't have a reduction all the way down to what it would have been if you spent 1% of the portfolio. You say, okay, I'm going to stop here at the floor. And that's the amount that you can spend.
So you're finding a middle ground.
Yeah, so really the thought is you're trying to preserve some of the upside. So we have found in talking to many retirees over the years is that when the markets go up, people don't necessarily need to increase their spending by 20 or 15% per year. So they could spend a little bit more, but it's better if they spend some and then reinvest the difference so that if the markets go down by 10 or 15 or 20%, they could actually not have to reduce their spending. So you're almost creating a little bit of a rainy day savings fund there. And it's a little more in line with what investors do. Like if the markets are up, maybe they would buy a new car. If they're down, maybe they'll cancel a vacation. So it kind of is a little more in line with how people think about their money.
I think that's true. People, regardless of how we want them to be robots and have no emotions in investing, the fact is when people feel richer, they're more likely to spend. We're talking with Colleen Jaconetti, who is a senior investment strategy in Vanguard Investment Strategy Group. She's been talking to us about different ways that people can decide how much money to spend during retirement. There's the dynamic retirement spending strategy, which she was diving into, which actually is a little more flexible. And the way, Colleen, I think you were explaining it is that people can choose a certain percentage of their portfolio they want to spend, but then have a little variability depending what's going on in the market. So let's get down to nuts and bolts. Let's say someone retires and wants to actually apply this strategy. What's the first step?
So the first step is to get their prior year portfolio balance. And I guess really the first step would be how much do they really want to spend? So they need to actually do a little bit of a budgeting or financial planning exercise of how much they need to take out of their portfolio. So if they come up with my income sources between Social Security, pension, part-time income, rental income is a certain dollar amount, then they say, well, my recurring expenses, whether it's healthcare expenses or food, travel, home, is another number. The difference between those two kind of gives them a rough amount of how much they need to take from the portfolio. So if they say they want to take 4% or 5% from the portfolio, we first calculate that number. So we do 5% of the prior year balance and we get a number. We would then compare that number to a ceiling and a floor. If that number that they had calculated is higher than the ceiling, we limit spending to the ceiling. If that number is lower than the floor, we limit the decrease in spending to the floor amount. So this helps keep their annual spending within a range of their initial spending calculated.
What is that range? How does a person figure that out?
So really this is where a lot of flexibility and planning comes into place. What we would do is show people a range of possibilities. You could say it's a percent of the prior year spending. So what we're trying to do is we're trying to control the year-over-year change in real spending. It really is an exercise you could go through as a financial planning exercise of if the market's up by 5%, 10%, 15%, and I increase my spending by 1, 3, 5%, what does that do to my outcomes? Meaning, what does that do to how long my money lasts and how much do I have at the end? And then it also is an exercise of people looking through their expenses to see what are a must-have, so food, clothing, shelter, versus nice-to-have vacations, new cars, things like that, and figuring out how much could they realistically cut their spending if they need to. That really helps decide what that floor amount is. So it's kind of going through the exercise of figuring out if the market should drop, if I have $50,000 of must-haves and nice-to-haves, how much of that is really must-have? Is it maybe only $20,000? That would be great because that means that the nice-to-haves could be cut if the market should go down.
Mm-hmm. It could be a little bit scary for some people, realizing that they are living at a certain level and they're used to it, and then all of a sudden things change. You know, for example, now we're in a low return world in terms of fixed income. So someone who is conservative in his investment approach and wants to have money in CDs or high-quality bonds, and he's getting very low yields, this could actually kind of shake him up because he says, wow, you know, I'm not even able to make the money that I would want to make in order to live the lifestyle that I'd like to lead. How do you sustain this kind of retirement income if interest rates are low and stay low like they've been doing for so many years?
Well, I think part of the key here is having a balanced portfolio in retirement. If you want a portfolio that is going to last, say, 30 or 40 years, there will most likely need to be some allocation to equities. So we would actually recommend that investors maintain a balanced portfolio between stocks and bonds, and don't try to overweight high dividend-paying stocks or high-yield bonds and things like that. Really focus on spending from their principal in years when they need to, and then living off the income in the years when the income exceeds the amount that they need to spend from. We try to say have a more balanced approach and then implement dynamic spending. So that's as far as asset allocation. Dynamic spending means have a little bit of flexibility in your annual spending needs. And having that flexibility actually helps people to be able to make sure they get their must-haves as far as expenses go, and then be also able to have some of their nice-to-haves and continue that for an indefinite period of their lifetime.
Mm-hmm. I hear. So it actually gives them a way to look at the amount that they're going to be spending within a realistic framework, because the fact is, you can want all you want about what the market's going to do, but if they're simply not producing the returns that you would like, you may not be able to spend the money. But it sounds to me, Colleen, what you're also pointing out is that people shouldn't be afraid of having money in the stock market to try to grow their portfolio, but just to do it within a measured amount. You said a balanced portfolio. Were you saying a 50-50, or were you just referring to some sort of planned asset allocation?
Yeah, really just some sort of planned asset allocation. Just generally speaking, if you have like a 30 or 40-year horizon for spending if someone's just starting retirement, they should have at least some allocation to equities to really help the portfolio grow through time and at least keep up their expenses with inflation.
Mm-hmm. All right. Hey, Colleen, I see we're just running out of time here. This has been really interesting, and I know that you actually have a lot more information on it. So in the last few seconds, can you just tell people how can they learn more?
Sure. They could go to www.vanguard.com. And if you go under personal investors and blogs, I have a series of blogs written on the dynamic spending strategy and sustaining retirement income in a low-return world.
Okay, and what we'll do is we'll put links to that at the show notes of today's show at goldsteinongelt.com. Colleen Jaconetti, thank you so much for taking the time.
Happy to. Thank you for having me.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.